we have a lovely presentation set up for you guys. Tyler's too modest to introduce himself, so I'll pretty well introduce him on his behalf. But we've had the pleasure and honor of working with him for known him all my life. But he's got some really, really impressive accolades that I'm very, very happy to share on his behalf. So Tyler's been in the business for quite some time now. Third generation realtor. Mom was a realtor. Grandma was a realtor. So we've been in business for, I say we because I've been working with him for a while. But we've been here for quite some time. He has been the top 35 list of realtors in Canada under the age of 35 years old for 4 or 5 consecutive years now.
Only 4.
Only four. And he's only got a few more years left of it. So, and extremely, extremely well-educated, well-read, and just a wealth of knowledge in the space. So without further ado, ladies and gentlemen, Tyler McLay.
Thanks, Anthony. Thanks, man. I just want to, before we get going, so hope you had your Red Bull and you're all fired up because we're going to talk a lot of numbers, a lot of stats, a lot of market update stuff. But before I get going into market things, I just want to thank Gary with Curated. If we could get him a round of applause. This is Gary, one of the developers on the site that you're in. Stunning project right here in Liberty Village. Gary, anything you want to share?
The only thing I want to interject is that I've known Tyler and his team for just probably a little bit over a year. And it's been an absolute pleasure dealing with them. They're so professional, so honest, and a lot of fun, and just an excellent experience.
Thanks, Gary. Thanks for that. Thank you. Thanks for having us. We appreciate it. So let's get into some market stats, okay? Last time we did a market update, it was 6-7 months ago now, and there was an elephant in the room, okay? But now there's no longer an elephant in the room. There's many. There's a lot of elephants in the room. We're talking about inflation. We're talking about tariffs. We're talking about mortgage rates, interest rates. There's a lot on the go. So our purpose with today's seminar is to give you guys some clarity, okay? Some direction. And what I think our team is most impressed with the market, the way we're interpreting the market data, is that we've got some predictability, okay? We've actually got a direction now. We can actually make some educated predictions in terms of where we're going. So we're feeling pretty good about how we can figure out what's going on. So we're going to talk about 4 things basically in order. How we got to where we are, how we got to here. We're going to get into what here means, where we're at today, okay? Then we're going to take you into kind of where we think we're going to go from here, what the outlook seems to be. And then we'll talk about where the opportunity is from here, how we can capitalize, how we can kind of take advantage of some of this predictability. So how we arrived here. Basically, pandemic, okay? Pandemic, COVID. What the pandemic really did was accelerate existing trends in the market. So what we saw during the pandemic was 3-4 years of growth kind of compressed into 6 to 9 months. It was wild, okay? And when the pandemic hit, money got really cheap. What we see with cheap money is insane volume and an increase in purchasing power. So the market went nuts, okay? Market went nuts and it led to aggressive rate cuts. Okay, there's 3 things we can do ultimately to manage what was happening there. We can increase outputs, which we couldn't do because borders were closed. We could cut rates, which we did to an excessive degree. And the final tool the Bank of Canada has or the government has is to ramp up inflation, make inflation go absolutely nuts. And that's exactly what we did. Okay, so that's kind of how we got to where we're at. Hence, inflation. So when money gets cheap and people spend a ton of money, inflation goes crazy. The value of a dollar decreases, diminishes. And real estate is impacted very interestingly via inflation. When money gets cheaper, in real estate being a hard asset is immune to inflation. Okay, so we tend to see real estate appreciate or at least remain on par with inflation. And that's in part why we saw a lot of the rapid gains that we did. What happened when we see crazy inflation? This all happened very quickly, like a roller coaster at Wonderland, happened very quickly, aggressive rate cuts, and then to combat the inflation, aggressive rate hikes. Okay, so this is a little more relevant to us, a little more, I guess, time sensitive. It's more recent. We saw rates going up and up and up and up and up and up and up. If you own businesses, if you're in real estate, most of you in this room, probably affected by the rate hikes. Okay, this is good for guys with lots of money in the bank. GICs go up. It's nice to have savings, nice to have cash, but ultimately we had to increase rates aggressively to combat this crazy runaway inflation. That's the only tool we have at our disposal to combat crazy inflation. Okay, we hike rates to reduce spending and limit the growth in our economy overall. We saw it across the board. Okay, but what we're seeing now is this normalization, which is providing predictability. We're getting back to normal. Okay, now what happened during this whole time? So how we got to where we are. there's a lot of investors, a lot of, not this room, because you're well educated, thanks to this wicked team we've got, but investors ignored the fundamentals. Okay, we got caught up in the buzz, we got caught up in the crypto, in the, what are those photos you bought online? NFTs. We got caught up in all this buzz, all this flow, and it's like tulip mania. Anyone familiar with tulip mania? In, I think, the Netherlands, tulips went crazy. Price of tulips, look it up, it's crazy. Tulip mania. There was no inherent value to tulips, okay, but they went nuts because the market made it go nuts. So we lost sight of the fundamentals, and what I want to do here today is bring us back to what's relevant and give us sort of a heading, give us a direction in terms of what we can look forward to. Does that sound fair enough? Okay, let's get into it. So where are we? Well, we're here. We're in Toronto, but from a market perspective, where are we? How do we understand where we are now? Let's get into some nitty-gritty stuff, okay? So new condo sales hit a 28-year low in 2024 as investors retreat. This is a headline we've seen across the board. Why? Why were investors so hesitant to invest in the market? Stagnation, lack of productivity, lack of predictability, okay? Now, development, like any other manufacturing product, there has to be a return when we make this product, okay? If I was to make this pen, I got a speaker here. If I was to make this pen for $5 and sell it for $3, I wouldn't be in business very long, yes or no? Yes or no? No, of course not. I wouldn't be in business very long. That's a terrible model. So the reason that condo sales hit a 28-year low is that the market could not sustain the price of real estate. Okay, so developers couldn't build at a price that was acceptable to the market. So condo starts stopped and the urgency kind of evaporated. Okay, so basically these stats are kind of staggering. Okay, new condo sales in Toronto are down 81% year over year and down 94% from the 2021 highs. That's crazy, is it not? Now, there's a famous Warren Buffett quote, and he says something along the lines of, we want to be fearful when others are greedy, and greedy when others are fearful. And if we took that advice during the COVID craze, we'd probably be in a better spot as an economy, but we're only human, right? We're only human. We like to keep up with the Kardashians. We like to do what everyone else is doing. We like to follow the buzz, okay? But if you look at these stats, I mean, condo sales in 2024, look at that bar chart. Like that's just wild. From 2004 to 2024 in a 20-year span, that's nuts, the lack of volume, okay? Now this is a fun one for me, Toronto new home sales versus condo starts. You can see the lag in condo starts based on the sales volume. So obviously, if people aren't buying condos, if investors, buyers aren't buying condos, why are developers gonna buy? We're gonna be in this excess inventory environment, okay? Now, this is where it gets fun. We're going to keep getting fun. Then we got the resale market. This sounds very pessimistic, right? Now we got the resale market, and we talk a lot about all this excess inventory. We just had an offer night last night, 15 offers on a property. It was nuts. There was another one. We had 4 offers as a backup offer, like competitiveness is back, in the right asset classes, in that entry-level market, okay? Single family, detached, it's getting nuts. Nuts. We're on the ground. We're in the trenches. We're seeing it. Condos are going to lag behind this trend. And you'll see why as I get into more of the stats. But condos are going to lag. We do have excess resale inventory because who's going to be the most hesitant buyer in a market that provides a lack of certainty? Well, it's very likely going to be that entry-level buyer that hasn't built up equity in their existing home, that hasn't built up any equity from the previous 20 years of gains. So a first-time buyer is going to naturally be more risk-averse. As we get a better handle on what's happening, as we get a better grip on the economy and where we're headed, this predictability, it's allowing consumers, especially the first-time buyers that have been stagnant for 3 years, to get excited about what's to come, okay, to want to make a move. You can only have this pent-up demand for so long before life happens. Kids, marriage, jobs, okay? Yes, we are oversupplied in the resale market, but you're going to see this change very, very quickly. Now again, where we're at today, this is important to understand where we're at today. Inflation's within target. That first slide I had, that one elephant in the room, it was inflation for a very long time. It was inflation. My mechanic, my barber, everybody was talking to me about inflation. They didn't even know what the word meant before 2023. Okay, but all of a sudden, inflation was the word of the year. Everyone knew what was going on. Oh, Ty, did you hear about the inflation numbers today? Yeah, I did. Right? Yeah, we're down. What does that mean? So we're right within this target range in and around 2%. We're actually 1.83 as of today, okay? So we're in that target. That's no longer the big Question mark, we've got inflation under control. Helps us enable the sense of predictability. A couple Wednesdays ago on the 29th of January, Bank of Canada cut rates a quarter point. Now this was pretty predictable, okay? There seemed to be the consensus in the market that the market was going to cut rates quarter basis point. Next announcement's on March 12th. Market's kind of already pricing in or considering another quarter point cut. There's a lot of pressure on the Bank of Canada to cut rates because our GDP is lagging. Our production is lagging. Because we increased rates by such a significant amount, the output isn't there. The spending isn't there. It's not back to where it needs to be to amplify our economy. We're just not there. So we need to continue these aggressive rate cuts and this rate cut cycle that Bank of Canada seems to be all on board with to be able to amplify our GDP. We've been stagnant post-pandemic. The United States is beating us tenfold. Okay, it's not a competition. Depends who you ask. Not a competition. But our inflation rate is basically stable, which is enabling the Bank of Canada to continue a rate cut cycle. When money gets cheaper, there's a very positive, very clear positive correlation. Real estate gets more expensive. When there's more access to capital, when money gets cheaper, asset values go up. So it's just one little piece of the pie in terms of where we're at now. Now, when we look at the bond market, this is important. The reason this latest rate cut was really significant is because we're starting to see the shift from fixed to variable. Variable is actually very close to, if not, depending on the bank you talk to, cheaper than fixed rates right now. The fixed rate is closely tied to the bond yield, Canadian 5-year bond yield. Okay? Bond yield has come down with amplified risk of tariffs and a little more, another sprinkle of the unknown, okay, thanks to our friends south of the border. But the fact of the matter is, the fixed rates don't really have much more room to go. The fixed rate mortgages are kind of bottomed out. We can't go lower than we are. The reason this latest rate cut is so significant is because variable rates are actually going to be cheaper than fixed rates again. That gives us confidence in the long-term outlook. Okay, that tells us that we're probably going to continue cutting rates, or at least the market's priced that in. Another important factor in terms of today, where we're at today, Canada's population in 2024, this is insane, grew by 1.2 million people. 1.2 million people came to Canada last year. That's insane. That's aggressive. Okay, 22, 23, 24, we had very aggressive targets. We hit them and passed them. So to keep up with this growth, this amplified population, this crazy population, and I'll get to some stats in terms of how many of these people are coming to Ontario and how many, what percentage of this immigration population is coming to Toronto. Okay, because we're not like the United States. If you want to be an engineer in the United States, where could you go? New Jersey, Boston, New York City, San Francisco, LA, you name it. Hartford, Connecticut, you got 40 options. Major downtown cores. What do you have in Canada? What do you have? Montreal, business hates Montreal because they speak French. BC, too busy surfing and flowing your hair in the wind. Okay, Toronto is it. So we see anywhere between a quarter and a third of all the immigrants coming to Canada as a whole, as a country, second largest country in the world, coming here to Toronto. Isn't that crazy? That really blows my mind. And that amplification in bodies, in people that need shelter, one of the core functions of life, we're not building enough homes. We're just simply not. We needed to add at least 500,000 homes last year. We only added, well, we actually added less than 250,000 homes. So it's increasing our housing shortage. What does that mean? Supply and demand. Simple investment 101. If you have more demand than you have supply, prices are going to go up. If there's more people that want this pen than pens that I have, it's going to generate a significant price, yes? Now, as I said, I alluded to, this disconnect was no larger anywhere in the country than Ontario. So you can see the housing shortfall in Ontario is just mind-boggling. How do we fix it? No one's got a plan. Okay, we've got to build vertical. We've got to build up. So varying age groups in this room, okay? My parents, when they were buying, they went outside the core because that was the play. You go outside the core, and I'll talk about the way Toronto is designed, but you go outside the core for affordability and starting a life. That was the play. It's not really a play anymore. Suburbs are also very expensive. Where are you going to go? Brantford? You can't commute into Toronto from Brantford every day. Even Brantford's expensive, but it's not realistic. So we got to go vertical. So the new entry-level units, the new entry-level product is condos. I'm going to talk about density as well, just how dense Toronto has become. When I did my master's, when I studied my master's degree at Schulich, this was pre-pandemic, there was a lot of talk about density and how major municipalities in Europe and all over the US were getting more dense, and Toronto had a lot of room to get more dense. Okay, bodies per square mile in New York City is 29,000 people per square mile. You might say, oh, we're far behind Toronto, Ty, but we're very closely related to LA. LA is 16,000 people per square mile. I know a kilometer is bigger, but Toronto is only 4,400 people per square kilometer. We got a lot of room to go in terms of density. We have to get more dense. We have to build up to try to tackle this housing shortage. A lot of the government intervention, I'm not political at all, I'm not going to talk political, but a lot of the government intention is meant to curb the demand. And you can't. You absolutely cannot fix this housing crisis by trying to limit demand. You can't. We need shelter. People need shelter. Immigrants need shelter. We need shelter. The only way it's going to be solved is by adding supply. And there isn't any new supply. But essentially, this densification that we're seeing, there's no land left. We've got Greenbelt, we've got Lake Ontario. We've got very strict lending rules, okay? The difficulty in buying is there. The difficulty in building is definitely there, okay? But this is a very interesting stat because we talk a lot about Canadian stats, Canadian this, Canadian that, but it's very prevalent and most prevalent in Ontario and the GTA. You see it every day. How long did it take you to get here? A while? That's density. Now, I talked about those elephants. One of the big elephants in that herd of elephants is employment. Employment's a big one. Now, we're higher than we were early 2024. Okay, early 2024, we were hovering around high fives, low sixes in terms of the unemployment rate. We're higher than we were, but we're working our way down. We're creating jobs. Now, what's really fun for me is a lot of the jobs that were created in October, November, December of last year were in the public sector, right? Government's job, let's make jobs, let's provide jobs, let's give people something to do. What we're seeing now is a lot of the job creation in the private sector. This is awesome. This means productivity is inching back, okay? We don't want to look at the stats when they're relevant and everyone's talking about them. It's too late. The market's reacted. We want to be trying to make judgments of what's to come based on the little clues today. And one of the big clues is that there's more jobs being created in the private sector and in the self-employed sector and then in the public sector as of right now. That's wild. That's crazy. That's, again, for me, that's like, whoa, eyes are getting wide, okay? Now, one of the reasons employment ticked up from early 2024 to late 2024 is not really what you might think. It's not that people are losing jobs. And that's what's really interesting about, this word recession gets thrown around, a recessionary environment. When we're in a recessionary environment, unemployment's in double digits. Always. Look throughout history. Unemployment is in double digits, always. We never saw that. This was a very unique, I don't even want to say the word recession, the R word, okay? We weren't even there. Technically, we never hit a technical recession. But a lot of the reason why unemployment grew from early 2024 to late 2024 is not because people were losing jobs. It was actually because of the rate of new immigration and not enough available jobs for the new residents. Isn't that crazy? There was so many new people flooding the market that it actually affected our unemployment rates because they weren't finding new jobs. I don't know about you, but that's an interesting one for me. That's another one where I'm like, wow, okay? Now, the good thing is that unemployment's working its way down. This is what you want to see. This is one of those other elephants in the room, and for the Bank of Canada to continue cutting their rates, this is something they want to get under control. We want to stimulate the economy so that the private sector can continue to create jobs. We're at the point where we're seeing that happen. That's the main point. Now, this is what was fun, is that the job gains were triple the economists' expectations. We love economists. They paint a pretty good view for us. Sometimes they're right, sometimes they're wrong, okay? Anyone making predictions, no one has a crystal ball. I bet on the Chiefs, right? What a mistake. But the point is that we blew that expectation out of the water. It's crazy. The estimate was 25,000 jobs. We added 76,000 jobs in January. This is the first step in a journey to recovery. I've been saying the worst is behind us. It's been behind us. But we've just had this stagnation for a little while. We're starting finally now to see some confidence return. Private sector adding jobs, employment increasing, wage growth is incredible. Wage growth in 2024 was actually the highest it's been in 14 years. Isn't that nuts? It's happening, okay? This is all good news. So that's where we're at. We know where we're at. And what does that mean for me? Well, I want to know where we're going based on this information. So let's look at what predictions we can make or what the stats are telling us about where we're headed. Well, this isn't a surprise. If you watch CP24 ever, you'll probably hear that we're expecting more rate cuts pretty aggressively in the first half of 2025. And what did I say happens when rates fall? Prices go up. Okay, it's a very clear correlation there. There's other factors impacting it, but black and white, that's kind of what we see. This graph, this chart, whatever you want to call it, was maybe from late November. But since Trump's been yapping, the Bank of Canada and the big banks are actually saying that we're going to cut rates even more aggressively. Okay, because with this talk of tariffs, we have to ramp up our economy more aggressively, so we're probably going to be a little more aggressive with our rate cuts. The average from the big 6 banks, they're calling for rates to be around 2%. Bank of Canada rate around 2% by the end of the year. That's nuts. What can we do with this information? We can take some action. Pretty interesting stuff. So that's interest rates. That's pretty positive. Let's look at immigration targets. Well, we're looking really good. We're looking really, really good in terms of immigration. Yes, we're going to cool it down a bit from the 22, 23, 24. Okay, yes, we're going to cool it down a bit. But I often make an example with my team with a cup. If I took a cup or one of those coffee cups and I dunked it in the ocean, and I dunked it in the Pacific Ocean, and I poured it out on the beach, would you guys be freaking out saying, water levels are decreasing, don't do that? You wouldn't, because it's a tiny little drop in the bucket. It's ineffective. So if you look at where we're at, our targets are still significantly above where they were in 15, 16, 17, 18, 19, and 20, pre-pandemic. So there's some talk of, oh, wow, we're not going to have the same amount of immigration. If I was to block off these stats, yeah, that looks like a drop, right? Looks like a drop. But when you see the full graph, I mean, we're still higher than we were 15, 16, 17, 18, 19, 20. And we still can't build enough housing for these permanent residents. This is a key word here. Canada will accept 395,000 new permanent residents in 2025. We don't have a shortfall of 250,000 housing dwellings. We've added a shortfall of 250,000 housing dwellings in 2024. Now we're in 2025, we're still short 250,000, more than that, but just from 1 year. And now we got 395,000 more people coming. What was the stat I told you before? Anywhere from a quarter to a third of all these new residents come to Toronto and the GTA. Where are they going to live? We got Lake Ontario, we got Greenbelt, we've got a finite amount of land we can build on and develop. Okay, so this is wild. Now the feds are targeting a reduction in non-permanent residents of 400,000 annually over the next 2 years. Okay, this is a result to make up for some over densification, we'll call it. But again, same like my ocean example, it's a drop in the bucket. They're not going anywhere. They're still very much here. The expectations of bodies and humans and people coming to the GTA, it's nuts. Okay, so the outlook is scary for available housing. Where are they going to live? Now this is a big one. Single-family building permits in Ontario hit decade-long lows. Look at this. Look how low we are in new housing starts. So we have all this new immigration, prices ready to go nuts because money's getting cheaper. And then we sprinkle in a little supply and demand problem from your grade 9 economy class, and we say, holy smokes, Ty, you were right. It's time to buy real estate. It's time to invest in real estate. It's time to deploy capital. Okay? So if we're not building new homes, where are they going to live? And if we have this existing inventory and curated that's actually building product, what do you think is going to happen to the value of that real estate as we move forward? It's going to go up. Interest rates, immigration, and no new housing. Let me take it one step further. I touched on this, I showed you this graph earlier, but it gives us a good indication of where we're headed. Condo starts are the lowest since the 1990s. So all this inventory that we need, all this product that we need, we're not getting it. And why? Well, because the market hasn't supported for the last 3.5 years the prices that developers need to sell at to make a measly little profit. Government takes a chunk, hard costs have gone up, Risk profiles have gone up dramatically. Cost to borrow money to purchase the land and construct has gone up. So it's been like full stop, full break, no action. And this is scary because what can we extrapolate from this information? Well, what I can extrapolate from this information is that a lot of the reason there's a lot of condos and a lot of talk about the condos out there now and this excess inventory is because investors forgot the fundamentals during the craze. They forgot the fundamentals. And if we consider the length of time it takes to start a project by the time Bianca's walking in, opening the door to her new condo, do you know what that average timeline is in the downtown core? Any guesses how many years you think it is for Gary to purchase a plot of land by the time Daniel's walking in, opening his door to his new unit? Any guesses, start to finish, timeline? Oh, very good. You must be in real estate. You're incredible. 7 year round of applause for Brenda. 7 years. 7 years. So a lot of this excess inventory that we're seeing now was sold in 2017, 18, 19, 20, 21, 22. Well, 21, when the market was nuts. So it's going to get completed now. But if we're not building anything, if we're not starting to build anything now, or we haven't for the last 3 years, when is that lack of production going to catch up to us? 26, 27, 28, 29, 2030? So we're very much forward thinking in terms of, well, when we get to that point and the immigration is still where it is and money's only getting cheaper and people need a place to live, are we not headed to a New York, Singapore, London type of market where buying is just no longer a thing? Where it's investor markets? Of course we are. So I can't stress enough that this timeline, especially for young people, it's shrinking. The opportunity to own real estate in the city of Toronto, it's shrinking and it's freaky and it's scary. We're going to be turning into that Singapore, that London, that New York, which sounded crazy in 2015, but it's really not that far away when you look at the numbers. So these stats tell us a pretty clear story. Okay, this is just really freaky. Toronto condo starts. It's not good. It's not good. I'll tell you what is good. Buying intentions jump. For buyers to make a move, and if you're investing in real estate, obviously you want to have an exit strategy. That's part of the play. What you need is you need willingness to meet ability. Okay, for anyone to transact, buyers need willingness and ability. Willingness is that desire, that want to do something, which hasn't been there the last 3 years, but it's back. 3 years of doing nothing, 3 years of having kids, getting married, getting new jobs, getting raises, saving money. Side note, household savings are even more now than they were during the pandemic when you couldn't go out and go to the Leaf game and spend money and go to the bar and people could only ever work and save. Household savings are actually higher than they were then, so that's another one. But willingness is that desire to do something, and that's back. That's there. Consumer confidence is back. The ability is coming back. The ability is the affordability, okay? Rates getting lower increases purchasing power, gives buyers more access to capital. So that ability is now finally possible. The CMHC, the federal government made changes to the CMHC lending requirements, which is insured mortgages, okay? Used to be a cap of $1 million. They raised that cap to 1.5. And you can amortize over a longer period. So that opportunity to get into the market is easier. So we're going to see a certain asset class, condos in the core, see significant gains as a result of the opportunity that now exists for first-time buyers and that entry-level product, okay? But buying intentions are back. This is very fun for me. Now, I just talked about affordability. This is a fun one, too. I'm not reading the stuff. If you want to read it as I talk, by all means. You probably figured that out by now. But Housing Affordability Index, look at the way we're working our way down. From mid-2021, we were a little wild, but we're working our way down. That's a result of cheaper money, no more stress test, easier access to capital, and federal government intervention. So affordability is getting easier. It's not that it's not still a challenge, but affordability is getting easier, more manageable, more possible. And this is good. Now, another one of the elephants is Trump's tariffs. Trump's tariffs. Anyone wondering if I was going to talk about Trump tariffs today? Probably. So look, here's where we're at. A little bit of uncertainty. Okay, this adds a sprinkle of uncertainty to our very predictable market. This is a new little sprinkle. Tariffs are implemented. Two things are going to happen here. Two things, in my opinion, two things can happen, or two things will happen. Inflation's going to go up, rates are going to go down. We're going to have to cut rates more aggressively to combat the lack of production in our market, or the difficulty in production. So we're going to cut rates more aggressively. Inflation, in this particular case, is almost unavoidable. Okay, if the costs of goods rise, things are going to be more expensive. So my take, or my prediction, is that 2% inflation is no longer going to be a realistic benchmark. I think that in the next 12 to 18 months, 3 to 3.5% inflation is going to be the new norm. And what does real estate do with inflation? Well, it's a hedge against inflation. You got $1 million cash sitting in the bank, that'd be fun. You got $1 million cash sitting in the bank, inflation's going to erode your cash. It's going to erode the value of your dollar. You invested in real estate, you're immune to it. And when rates go down, let's test again. What happens? Rates go down, prices go. Everybody now. There we go. Prices go up. So rates go down, money gets cheaper. So the only two things that are going to happen from a real estate perspective with the tariffs is rates are going to go down, which is good for real estate, good for your investments, and inflation is going to go up, which is actually hedged by your real estate investments. So that's kind of cool. Now, you might be affected differently in your business, this, that, and the other, but I can only speak to real estate. And I can tell you from a real estate perspective, my buyers buy in Canadian dollars because they make money in Canadian dollars. They pay their mortgage in Canadian dollars. So the value of the dollar for me, for my real estate market, don't care. It's ineffective. So all this talk about the dollar, it's irrelevant to me and my real estate market, really. Will it affect output? Maybe. Will it affect inflation? Probably. But real estate within the confines of our Canadian boundaries? Not really. Anyway, this is interesting. Changes in mortgage rates and housing prices over time. So when mortgage rates have risen over 20% year over year for more than 2 months in a row, the rate of house price growth has slowed. Now, what's really fun for me here is if we flip it, if we consider the inverse, when we're seeing rates decline at a rapid rate over the same period of time, what do you think prices do? What do you think price growth does? Well, it goes up. So this is where we've been, and where we're headed with rate cuts is we're going to see an amplification in transaction volume, which we need for prices to grow. Consider where you live right now. Consider where you live right now, your home. Close your eyes and imagine your beautiful home, okay? If your neighbor sells for $2 million today, is it realistic to assume that next week you can generate $2.8 million for your home? Probably not. So for this price growth to actually happen, first we need transaction volume. And that's what's happening now. We're seeing the transaction volume. With the delayed closing, with a delayed outlook, with a long-term outlook, when in doubt, zoom out, I often say, you're going to allow that transaction volume to happen and give the price growth the time it needs to take effect. Hope that makes sense. Now, I talked a little bit about this, okay, this pent-up desire to do something. It's been 3 years of nothing. Since mid-2022, boring, lame, real estate market's been stagnant. 2023, boring, lame, real estate market, quiet. 2024, crickets. People have to live. People are graduating from school, finding jobs. People are having kids. People are getting married. People are finding things to do. So that doesn't change a major segment, a major piece of decision making. Okay? So here's your consumer confidence stat. Consumer confidence is way back. If you look up at just general consumer confidence in the economy, it's actually a kiss down, just a little bit lower than we were. Big contributing factor to that is jobs. People don't feel super secure with their jobs right now, rightfully so. I think all is good on the job front, but mentality effect. In terms of real estate specifically, the confidence in the outlook for the real estate market has risen significantly. And what do people do when they're confident and feel informed about something? They take action. They make a move. They buy. So we're seeing this return in those entry-level assets. This is nuts. Even with the volatility we've had in our market, the rate of growth in the GTA, it's mind-blowing to me. 7% year-over-year appreciation since 1978. And this holds true for the last 5 years. Oh, Ty, 2022 sucked, 23, 24 was quiet. The last 5 years, with the growth we had in 2021, simply normalized and we averaged out to 7%. Big window, small window. in and around 7% annual price appreciation. That's crazy. That's just crazy. And this is before we even factor in leverage. I don't buy my investment properties in cash. Some of my clients do. Some of you maybe do. I don't, because I love leverage. I love taking advantage of a mortgage. So my return is amplified over and above the 7% return on the asset value. It's on the return on equity, my investment. So it's much higher than that. Okay? But basically, this is a fun one. Anthony's big on the rule of 72. Okay? Basically, what this means is that prices double in about 10 years. Prices double in 10 years. Should I say it again? Ali, can you hear me? Prices double in 10 years. On average, based on stats. This is not an opinion. Okay? There's a handy, quick rule for figuring out how long it would take for the value of an asset to double. It's called the rule of 72, and all you need to do is take 72 and divide it by the rate of return. Just for you guys in the back that can't see it. It's a fun one for analyzing your investment property. But that's a fun one for me. Now, even with this positive outlook, okay, we don't want to get carried away. We don't want you making rash decisions. So we have to get back to the fundamentals. We pride ourselves as a team as keeping our clients very much informed, very much educated on the fundamentals of our market and what makes a quality real estate investment versus getting caught up in the buzz. Okay, so there's a lot of fluff you'll see out there, a lot of crazy incentives, crazy low deposit structures, cash back, free this, free that. Doesn't always mean it's going to be the best investment. So we have to make sure we're considering the fundamentals when we get into investment real estate. Okay, so let's talk about why you should care. So this is one of the big fundamentals for me. And I talk about this a lot. This is the way Toronto is designed. This is the way Toronto operates. It's called a concentric city model or a concentric zone model. We have a nucleus. The nucleus is Toronto core. Now, science tells us that the further we get from the core, the cheaper real estate gets. And what we've seen for the last 20 years, pre-pandemic, is we actually saw suburbs grow at a more significant rate. And this is a very Canadian-specific thing. This is a Canadian behavioral thing that we like suburbs. Very weird from a science perspective, okay? And what we're gonna see now, I'm very confident, I'm very certain that we're gonna see price appreciation in the core significantly amplify the periphery. So the point of understanding what a concentric city model is zone 1 is called the central business district. That's where we are. We're downtown Toronto, okay? This is where the jobs are. This is where people want to be. This is where there's access to transit. This is where incomes are higher and there's things to do. If the Toronto core, sake of the argument, let's use the example 7%. If the downtown core appreciates 7%, you would, science tells us, expect zone 2, the zone of transition getting out of the core, would be around 5.5%, less so than the core. Then we've got the zone of independent workers' homes. Again, this is an older model, but it's very true to our market. As you get further from the core, maybe zone 3 appreciates 4%, 4.5%. Everything further from the core, it's affected by the Toronto market. Why is Bradford so expensive for some reason? Because Toronto's expensive. If Toronto got way cheaper, Bradford would kaput. Okay? Everything, all of our periphery, all of our suburbia is a result of the downtown Toronto growth. If you live in Bradford, what do your neighbors do for work? They commute to Toronto. For work, they commute to Toronto. They come to Toronto. So they're trading off that commute, that distance, for cheaper real estate. The interesting thing is the real estate hasn't actually been cheaper in the periphery. So we're going to see a massive correction generated from this model of the downtown core amplifying and increasing those returns compared to those periphery markets. Okay, but I'm a big fan of this concentric zone model. Now, population density is really important to consider. I told you this number before, 4,400 per square kilometer. When I did my master's, all the talk, all the conversation was density, density, density. Smaller condos, smaller units, shared economies, zip cars. Anyone know zip car? Or like a Zool, right? Shared cars. No one needs a car. Developers are nuts to even build parking anymore, Gary. It's crazy. No one's going to be driving in 5 years, right? Transit, shared cars, Ubers. You don't need a car. The cost of a car is nuts. So developers are paying attention to this stuff. But my point is, we aren't as dense as we could be nor should be. So we're going to see the growth. We're going to see, again, that immigration moving to Toronto. We're not building enough, but it'll come. It'll come. The people will be here. The bodies will be here. And our density numbers are just way below where they should be. When I did my master's, the talk was all about density. And then when the pandemic hit, it kind of reversed. Okay, and we're still in correction-ish mode, but the fundamentals are coming back. COVID was weird. COVID was different. COVID was interesting. Okay? During COVID, there wasn't really a draw for downtown. You couldn't walk to the Leaf game because you couldn't watch them. You couldn't go to the bar because they were closed. You couldn't walk to work because you worked from home. So why am I going to sit in a 400 square foot condo and work? No, I'm going to move back in with mom and dad. Oh, I want a backyard. I want to get 7 dogs. I want to move further away. I want to do something nuts. Let's move to Collingwood and I'll just commute when I go back to work. Seriously, I had clients say, I'm going to go to Collingwood. I said, probably not a good idea. They did, and then they sold 2 years later and came back. So good for me, bad for them. Point is, density is a real thing. Density is a real, serious thing. And we need to understand this concept of density, of the core being valued above the periphery, because this is where the growth is. This is where the people are coming. Post-COVID, this density trend has returned. So we're going to see a lot more of this. Buckle up for that. Population growth, now let's get a little Toronto specific. Downtown Toronto is going to add 700,000 people and 450,000 jobs by 2051. That's crazy. I think we're only the 4th largest city in North America still now, right? Mexico City, New York, LA, us. 3.6 million residents. That's Toronto proper. Like, that's Toronto core. That's not GTA. Where are they going to live? I just told you that we're not building condos. We're not building units. For a long time, we had the most cranes anywhere by a landslide. Do you see nearly as many anymore? No, because there's been 3 years of no growth, no building. No one's going to break ground. Why would you? If you were in a developer's shoes and there was tons of uncertainty, it's totally unpredictable, you don't know what your costs are going to be, and you can't sell at a price acceptable to the market, you're just going to wait. And that's what they've been doing. They've been waiting. Okay? We need some condos. So this shows you, I talked a little bit about the US there and how we're different from the US in terms of options where to go. The red, I think, is Montreal. Red's Montreal, green's Vancouver, blue is Toronto. You can see the acceleration toward the right side of the graph, the acceleration in movement. Toronto's got the jobs. Toronto's attracting the right employers. Toronto's bringing the investment from a federal, provincial, and municipal level in infrastructure. Toronto is the place that anyone coming to Canada wants to be. But I mean, the numbers are incredible. You can read what's on the screen. Okay, Toronto CMAs, the central municipal area, is growing at its fastest rate since 2001, with a record 3.9% increase last year, surpassing the previous year's 3.8%. So that growth in population isn't just Canadian-wide. It's a lot of it is Toronto specific. So here's some more fun stats for you on Toronto, why we love Toronto. You guys love Toronto? I do. Maybe not the Gardener these days, but whatever. We're the #1 fastest growing city in North America, even still, even after this stagnation. And that's in terms of population and population density. 4th largest North American city, we know that. That's great. 98% expected population increase in downtown Toronto by 2041. Isn't that nuts? Double. You think traffic's bad now? Buckle up. That's nuts. 2nd largest financial center in North America. Anyone know that? Second only to Wall Street, New York. We're the 2nd largest financial center in all of North America. We're the 7th largest financial center in the whole entire world. We're still very young. We're still very immature. We're like a tween right now. We got a lot of room to grow. 316,000 new jobs in downtown Toronto by 2041. What does that mean? These are the jobs people want. These are the jobs that our talent pool is studying for. Incredible post-secondary institutions here, okay? That's why employers want to be here. They want our talent. So these jobs are going to be high-paying, high-productivity jobs. And 37% of all jobs are based in the downtown core. 4th most desirable city for students in North America. That's kind of fun too. So here's some of the fundamentals you don't want to ignore if you're considering an investment. Okay, we're getting toward the end here. #1, big one for me, job growth. If people don't have their jobs, how the heck can you expect them to pay their rent? You need employment, you need jobs, you need high-paying jobs, you need quality jobs, you need a low unemployment rate in a specific community, in a micro market. You need income growth, because as real estate gets more expensive for my investment to make sense, I need to make sure that my tenants or my renters are making more money year over year. We're seeing that here in Toronto, specifically Liberty Village. Neil's got some stats for you on that after. Population growth we've talked about in excess. If you have questions on that, great, but we talked a lot about it. Existing infrastructure, these are two big ones for me. Existing infrastructure and future infrastructure investment. So there's different markets across the GTA. There might be some that come to mind where there's nothing. Blank slate. Oh, Innisfil, the orbit, if you've heard of that. Innisfil's gonna go crazy. The orbit. Maybe by 2074, okay, when the orbit's finished, and that's great, but there's nothing there now to make Daniel Cheatley want to move to Innisfil tomorrow with his family. Is there? No, probably not. So what's important to me is a confluence of existing infrastructure we have and the potential to add future infrastructure. Schools, community centers, transit, which we have in Liberty Village. Anyone know about the growth plans at Ontario Place? Pretty crazy. Anyone know about the Ontario line? Pretty wild for connectivity. Okay? Stable economic and political environment. We've got that here. We feel good about that. Post-secondary institutions, some of the best in the world, globally renowned. We have a diverse economy. Diverse economy is important. There's a lot of talk about Calgary. A lot of talk about Calgary being the new up-and-coming investment pocket. And I don't mind Calgary. They're starting to diversify their economy. They're starting. So for an entry-level investment, don't mind it. But for a very long time, Calgary was not diverse. And there was people going nuts for Calgary, and it was stagnant for 10 years. I didn't want to talk about it because they were a one-horse town. Oil, oil, oil. They're finally starting to diversify, and that's why I'm starting to maybe pay attention. Okay? But Toronto has one of the most diverse economies. Huge healthcare sector, huge finance sector, huge post-secondary institutions, huge film industry. We're incredibly diverse. So that means if one balloon pops, if one industry fails, runs away for some reason, no reason to, we've got a lot more to fill in those gaps. That's what makes me confident as an investor. Okay? And with the diverse economy, we want a diverse and talented workforce. We've got that. Now, I talk a lot about an insulated market, and sometimes I don't go into detail what I mean by that. Well, we're insulated in a number of ways. Number one is it's tough to get a mortgage. So those that are buying are qualified to buy and can sustain fluctuations in interest rates. Mortgage delinquencies. 50% of mortgages are going to renew in 2025 and 26. I'm not worried about it because rates are almost on par with where they were when they had the first mortgage origination. I'm not worried about it. Delinquencies came in way below expectations. Canadians have money. So that's just headlines. Doesn't bother me. So qualification to get approved, the stress test, it worked really well. We're insulated by our land. There's not much land left. You guys see any vacant land when you were driving around? Anyone go shopping in Buffalo over the holidays? Anyone? That's always fun to do. Drive through Buffalo, tell me how many vacant apartment buildings and land you see in their downtown core. We're not that. There's nowhere to build. So we're insulated in that respect. And that's another thing I really factor into my investment potential. You look at the VMC, good project, it'll make some money. Okay, you'll do well there if you invested there. But to me, it's a blank canvas the size of this room. The size of this room. And they've only built on this carpet so far. So there's a lot left to go. There's a lot left to build. By the time your condo's done, you're the old guy and the new one's ready to go. And they're talking about the new one with the new innovation. To make a smart investment, you want to be insulated with a lack of available land to add new. That's what Toronto has. That's what Liberty Village has. Okay? So we're very bullish about Liberty Village. High costs, obviously. Cost of ownership is expensive. Difficulty to build new real estate. It's difficult to build in Toronto. Staging areas are impossible. They almost don't exist. So you've got to be a sophisticated builder to be able to even build here. You can't just get me and Jason decide to put some money into something and say, let's build a condo. We can't. We can't. Okay? The difficulty is immense. And then I mentioned a couple times the greenbelt and the lake. We can only go out so far. Can't go into the lake. Can't go north beyond the greenbelt. And even if you do get into Peterborough, it's too far of a commute for Torontonians. Okay? So we're going this way. So these are some of my fundamentals. Now, choosing assets, some of the things I look for when I choose assets, these are important, and these are factoring appreciation and cash flow. Hands-off, minimal management for me. We're busy people. We work jobs. We got businesses to run. We got things to do. So I want as little investment as possible of my time. I don't want my tenants to have to have a car. Parking's expensive. I don't want them to have a car. I don't want that. I want them to be near transit in a location where they can walk to whatever. Bikeable, walkable, you want high scores on those. Now, this is a fun one, unique to me and my team, I think, but intentional uniqueness. Intentional uniqueness. Rising tides raise all boats. Yeah, you heard that one? No? Yes? Yeah. Still awake? Need another Red Bull? Okay, almost done. But intentional uniqueness. Intentional uniqueness insulates, I'm going to use that word again, insulates you from saturated markets. So in markets like this, where we've got a little bit of surplus of resale inventory, no one's buying the cookie cutter units because the cookie cutter units in cookie cutter buildings are replaceable. So I can only compete on price. I want intentional uniqueness, something that makes my building and my unit special so that I can attract attention from the buyer pool. In crazy markets, when rising tides raise all boats, who cares? This guy sold 710, I got 720, 730, 750, 850. It's like a friggin' auction house, right? It's nuts. That's not the market that we're in today. It's not. And it's not the market that we can guarantee we're going to be in when we deploy our exit strategy. Any smart investor has to have an exit strategy. So we think about this ahead of time. Oh, I'm going to buy with everybody else one of these units. It's a good buy. Yeah? How are you going to sell it when there's 13 for sale of the same unit? You're only going to be able to compete on price. Unique assets, intentional uniqueness, get better prices. So that's something you're going to want to look for. Functionality and design, we know this. Functionality in the unit design, especially in condos, you need functionality. You don't want anything weird. Clients, buyers don't like things that don't make sense or they're hard to visualize how you're going to lay out a space. Okay? You want a qualified tenant pool, qualified, diverse. You want to have a pricing model that's accepted by the market. So when you're buying, if you buy too high, you're already waiting for the market to catch up. If you're buying something that is already priced very aggressively and very in line with the market, then you're already ahead of the game because it's only uphill from here. Okay? So we really want pricing to be accepted by the market today, not tomorrow, not next month, and that's something Curated does incredibly well. Talked about existing and future growth. Community identity is important. You're going to get amplified returns if your community has an identity. What's a pocket in Toronto that you like? Shout it out. What's a pocket? Rosedale has an identity. Give me another one. Leslieville has an identity. Sure, give me another one. Liberty Village, right on. Distillery District, Yorkville, they have identities. So when you're in a pocket that has an identity, you're going to find buyers and investors say, I want to be in Liberty Village, Yorkville, Rosedale. Okay? Limited availability to add new, immediately comparable supply. That's the majority of the GTA, but specifically true in Liberty Village. So we're really, really, really bullish on that. Okay? Now this leads me to, based on all my stats, based on all my numbers, based on all my market data, we believe the best opportunity today is in pre-con. Pre-con that's going to be completed between 2027 and 2030. Okay, why do we love pre-con? Predictability in payments. Hands-off investing. You're not getting a mortgage, you're not managing tenants for a while. You let the market do its thing based on all those fun numbers I talked about. Capital appreciation and leverage. The market is doing incredible things. Let the market do its thing. Park your money predictably, hands off. Let the market do its thing. The numbers are telling us prices are going this way based on a number of factors. Okay? Customization and suite selection. You can make your suite a little bit unique, a little bit different so that you're not just one of many when it comes time to exit. Lower maintenance and repair on new builds are awesome. Let me ask you this. Pull out your phones for a second. Just pull out your phone. Hold it up. Just pull out your phone. Seriously. Is that the same phone that you had 10 years ago? No? Is this a little more advanced than what you had 10 years ago? Has it come a long way? Sure it has. Can it do more things? Sure it can. What about your car? A little bit newer? Can it do more things? Same with pre-construction. We don't think about it in our market. We don't think about it in building. We don't think of innovation in building. But there's a lot of really cool things in terms of green initiatives, in terms of amenities that are intentional, again, in terms of suite design, suite mix in a building. Okay? So getting something new, getting something more modern, not just in design, not just in functionality, but newer, actually lends itself incredibly well to investors. Okay? And that's why I say latest and greatest innovation. So that's why we really like pre-con. And what you're going to see is anything that's getting launched now, you're going to be one of few when it's done, when it's ready. So assignment options will return. Okay, I'm not buy to close, but assignment options will return. The way the market's going, we're very confident that we're going to see some appreciation. So I won't spend any time on this, really, but this is just some of my must-haves for investing, just to summarize a lot of what I talked about. 8 Temple, the project that you're in, there's a beautiful model suite behind us there. If you walk down that way, it's sensational. But I can't say enough about the guys at Curated and what they put into the intention in their buildings and their product. And a lot of that lends itself incredibly well to the resale, to the return. And Neil's going to talk a little bit about this. But for me, reputable developer, you've got it here in Curated. Gary and Adam are just some of the best people I've ever met. Existing neighborhood amenities, look around, you got it. You saw a lot of them when you drove in. Amenities to come, we've got a lot of growth coming at Ontario Place. We've got a lot of growth coming with the Ontario line. Projected growth, I talked about it. Access to transit, steps away. Great deposit structure, Neil will speak to it. Unique suite mix and layout, it's a big one for me. Okay, high-rise buildings are cool, very replicable, but not enough ability to stand out. Appreciation potential, I must not have done a good enough job if you don't think there's appreciation potential in our market here today. All signs point green light, go. Exciting and existing rental market, it's exciting and it's existing. Okay, some of the returns in Liberty Village, the time to lease are some of the best in the city, and the premiums you get on rents in Liberty Village are the highest that you see in the city, so we're very bullish on Liberty Village as a whole. Quality tenant pool, you've got it here. You've got young professionals working hard, great demographic, and then very limited ability to add supply. So with that, I'm going to stick around for questions with Neil after, but I'm going to introduce Neil. Neil's going to take you through a little bit about what's coming from Curated and a little bit about what this beautiful site is actually going to deliver. So thanks, Neil.
No problem. Hi, everyone. This is the next 2-hour segment, so don't worry, I'm joking. This is where you get the cheesy sales pitch. No, you don't. My name's Neil Hughes. I'm the Director of Sales with Austin Birch. We act for a number of the top developers in the city, including Curated Properties, who we're fortunate to work with for a number of years. So we just really want to quickly talk about what Curated does, a little bit about the buildings, but again, it's going to be quick and snappy. I'm not going to get into all the stats or go through in depth on the deposits or anything like that. You can talk to myself, the team. Belinda's here, Tanya's here. All our screens are interactive. We've got all the marketing information and price lists. So we'll keep it quick. You can all get over to the Brazen Head then for your drink straight after. So I'll jump into kind of what we've been doing. So Gary obviously spoke to a little bit earlier on, but Curated are developing for quite a long time. They're in the development industry since the 1980s. It is very important to understand when you're buying into pre-con before you get into the glossiness of the incentives, the deposit structures, you know, the credits on closings, that the project's going to be built out. It's no good if you don't have a reputable developer. So in terms of what Curated have been doing, they've been building kind of world-class, some of the best developments you've seen throughout the city. You've seen the plant on Queen West at Queen and Dovercourt. That was the 2018 project of the year. We're currently under construction for Accra, which is at Yonge and Eglinton. And again, their philosophy kind of on their site acquisitions, and Gary, correct me if I'm wrong, is they like to acquire near a major intersection without being on that major intersection. So every site they tend to buy into is 10, 15 minutes, usually 10-minute walk within a major intersection, which means you're not paying the premium for that location, but you're still close enough to get accessibility to the subway, to the transit, or whatever that location may be offering. So in terms of what we're doing right now, we've got Accra under construction, which is a 22-story building at Yonge and Eglinton. And again, when we talk about their finishes, I suppose a lot of the market is familiar with, where's Daniel Kim? There he is. It's never too far away. So again, what I think Curated are very well renowned for in terms of the industry as well, and Daniel and Ty and the team would speak to this. The standard finishes at a very high level. So when you're buying in, including me as a buyer with Curated, when you buy into their buildings, the standard finish would be considered upgrade in 99% of other developments in the city. Now again, I can't show biasm. I do act for a lot of developers. I do have a soft spot for Curated in terms of just their ability and their attention to detail on their finishes. We went down to the Ritz-Carlton in Mexico City, which is designed by Shapi Chapo, who are actually partners with Curated on their buildings. So Shapi Chapo are the design team behind Accra and 8 Temple. They are world-renowned design team. If you're not familiar with Curated as a developer, you just need to look at their design partner. They've designed the Four Seasons, the Ritz, the St. Regis, any of your high-end 5-star hotels. They are usually behind it on the design side as well. It's also the first time that Shapi Chapo have agreed to work with a residential developer. So that is a huge point as well. For them to agree on a partnership is a very, very big selling point for us as well. it also showcases who they're partnering with too. So I think a big thing about that is a lot of developers who we know personally have approached them. They won't work with them. They don't work with a cookie cutter style developer. They prefer to work with a developer who's doing boutique high-end buildings, so unique finishes. So again, there's nothing cookie cutter about what Curated is doing. When we jump into kind of some of the finishes we have and kind of what's the offerings, the nice thing about Curated, excuse the pun, is we can curate the plan towards each buyer. Whether we're curating a design finish, whether we're doing a lot of floor plan changes right now, which developers hate. Gary, close your ears. Most developers don't like getting into changes on floor plans. It's a logistical nightmare. Nearly 90% of the deals we're doing, and Tyler can speak to this, we sit down, it's an in-depth conversation, we meet here at the gallery or in Curated's office, we'll go through that floor plan, make the changes where necessary. If it's a wall, if we need to change a shower, whatever it may be, we will get into that customization, obviously where possible from an engineering and architectural point of view. But it's a big selling point, particularly for your end user buyers as well. Again, keeping on some of the stats and some of the offerings we have a wide range of buyers, from first-time buyers to end users in a lot of our buildings. We try and customize our deposit structures to meet that buyer's needs. If there's cash flow that they haven't got that whole lump sum available, we'll try and work around that in terms of customizing the deposits as well. So again, depending on what you're looking at, we will make those changes where necessary. When we look at locations and growth, I think we need to jump into what Curated's latest building is, 8 Temple. So the gallery you're standing in right now, a lot of the finishes that you're seeing, the archway, the bar area, the vignette that we have in here behind me is kind of an example of what you're going to see in the finishes of this 8 Temple building. We're literally a 10-minute walk west of here, right at King and Dufferin. We're literally 10-minute walk down to the lakefront, 10 minutes into the Liberty Village itself, and not to mention the transit. The transit accessibility, for those of you who aren't familiar with this location, you can literally get the GO train from Exhibition Station right into Union. It's one stop, it's 7 minutes. And again, I'm not giving you the sales Google Maps times. I live beside Union Station. It's quicker to get the GO train from Union to Exhibition and walk to this site or this gallery. You can genuinely do door to door in 22 minutes. And you can quote me on that. I'm on video. So if anybody wants to challenge that, I'm out in the open now. So, but genuinely from a transit, we've also got the subway accessibility, and we've also got, again, streetcar right outside your door as well. So from that point of view, it's ticking all the boxes, whether you're an investor, I'm buying for investment, or whether you're an end use, 8 Temple is offering all those facts that you need. Again, looking at locations, I think as we mentioned earlier on, Curated are renowned for buying into locations that aren't just fully established yet. And that is the same philosophy as a buyer. I know if I'm buying for investment, whether it's pre-con or resale, I tend never to buy in an area that's already established. You want to buy into a location that you're going to see the land value increase, which the developer, which of course is the aim of the game, and you as an investor, or you as acquiring your first home or your condo, whatever it is, you want to see those values increase and you want to see the area start being established. But again, speaking on the location for 8 Temple, we've also got the new King and Sudbury subway line, which we didn't speak about as well, which is already under construction there. Okay. So again, as we go down, we look at some of the comparisons. We spoke to Chappie Chapo. We'll fly over this. And then I think one of my favorite features, I get very excited about this, at 8 Temple, we'll show you on the screen when you come in. What we've done here is we put all the amenity space for this building on the top floor of the project. I can tell you categorically, and Gary and the finance partners would not have been too enthusiastic about doing this. We're eating into our penthouse units here, which would have been huge value. So this is not your lower penthouse. We do not have penthouses in this building. The whole top floor, the 15th floor of this building, is all amenity space. So what have we got going on up there? We've got these outdoor sauna pods, which are right located at the edge of the building, glass finishing, facing out to your lake view, which I'll showcase in a moment. We've got a pickleball court. We've got an indoor and outdoor commercial grade kitchen. And again, I'm speaking to all these points on the top floor of the building. We've also got a full indoor and outdoor strength and conditioning outside as well. And again, all these features face the lake. As we know in condo buildings, we always have these fantastic amenities. They tend to be buried into the second floor of the building. The north side, the east side, dark. It's fine, you want to get in, you want to get out. I hate the gym, but in general, it does make it easier if it's a nicer, brighter space. This is fantastic. We'll show you on the screens when you're mingling around after, and we'll show you some of those lake views as well. But it's very, very special to showcase. And the idea behind this is we want to encourage people, without being cheesy, to stay within the building, not going out to external gyms, not going out to your wellness centers. All the amenities that you need are going to be within this building. If you're a first-time buyer on a first floor, 1-bedroom unit, your starter home, maybe looking north, you don't have the best desirable views, then you've got all the top floor space to avail of as well. So all our party room is on the top floor. Again, we've got an incentive tonight, which is up on the screen, so it's quoted now. Gary will have to sign off on it. We're doing 15,000 credit on closing for any people that are interested in speaking to us tonight. 15K design credits towards suite upgrades as well. That's really doubling up on the value because the design finish is already at an elevated standard here. And again, we're also offering these competitive 3K a month deposit structures, particularly attractive for first-time buyers who don't want to be getting rid of all that cash savings straight away. And again, we can extend our deposits where necessary. Like all deals, Sue, Daniel, Noel, any of the team we're speaking to, Tyler, every deal is unique. We will customize it where possible to meet that buyer's needs. Accra, again, we do have some remaining units. The crane construction's already started on site in this project. We're at Young and Eglinton. So again, we're going to offer the same credit on closing here, up to 75,000 in suite upgrades, again, which you're seeing by Shappy Chapo Design. Again, if you're not familiar with Shappy Chapo, worth having a look at their website and see what they actually do. And then similar to a temple, we can look at customized deposit structure and just 10% down within the first year. So again, there's a lot of offerings. I think to kind of quick overview from my point of view to speak what's happening in the market, we can look at all the stats. That's very important. As I said, we're speaking to a lot of developers daily, development teams, the lands teams. What we're seeing happening in the market right now is, yes, it's incentive heavy. There's offerings. Some sites, a lot of them won't make sense from a pre-con point of view or resale, whatever it may be. Where you're going to have a problem, though, if you put everything to one side, and Tyler will agree to me on this, is there's going to be a massive shortage of supply in the Toronto market over the next 7 to 8 years. That's a fact. Because I can tell you, normally we launch 7, 8 buildings a year. We're not launching anything this year from our company's point of view. A lot of other developers we're dealing with, a lot of big name developers are also not launching. What's this going to lead to? Massive supply. Massive, massive supply issues. So I think you should obviously do your due diligence. Tyler and the team are fantastic at what to do. We've worked with them for a long time. They dive into, things that won't make sense. They ask the hard questions. They drive me crazy every day asking for more and more and more, which Gary has to agree to. So again, speak to the team. If you have any questions, even from a pre-con point of view, we're here. Have a mingle around, take some food, some refreshments. If you want alcohol, the team will run over to the Brazen Head and get it for you. But otherwise, we're here to answer any questions anyone may have.